Will there be, what kind of reply will suit them? These kind of questions are always there as a registered valuer for each one of us. IBBI has instructed all the registered valuer organizations, RVOs, to have a session with their members and to instruct them with respect to the peer review findings. Okay, whatever findings any RVO or IBBI has seen, considering all our fellow professional reports, they want to alert all other valuers so that the same mistake is not repeated by any others. And the same topic, few other RVOs have also conducted sessions, but we thought our BVA members should definitely be aware of what are the peer review findings. I request Jivika to introduce today's speaker to us. Of course, Mr. Sumit is our PVA member, so I'm glad to start his session today. Over to you, Jivika.
Good morning, everyone. Mr. Sumit Dhadda is a managing partner of DLS and Associates LLP, having offices at Delhi, Jaipur, and Bangalore. He has more than 17 years of experience in multinational audit and accounting firms, and he has performed more than 100 valuations. He is also an insolvency professional and a certified anti-money laundering specialist, and he is a regular faculty in IBBI valuation courses. Welcome, Mr. Sumit, and thank you for accepting our invitation and joining us today. Over to you, Shilpa.
Yes, Vijaya, can you stop the share? Mr. Speaker will be sharing his screen.
Sure, ma'am.
Can I start?
Yes.
Thank you, Shilpa, for inviting me, and thank you, Jivika, for the warm introduction. Bangalore is like a second home to me, as my wife is from Bangalore, and when she was very happy to hear the session at Bangalore Values, because and get updated. Now, let me give you some brief before we take on further. So first of all, I thank you all those who have joined just now. Being on a season becomes a little bit difficult to stuff. So the government is calling it as a valuer's birthday.
In fact, in between your voice is breaking.
October. So the IBBA. Sorry, you're saying, Shilpa?
In between your voice is cracking, like in between, on and off. We can hear 4 words and then we can't hear 2-3 words.
Just give me a minute. Let me see if I can. It is not working.
Just for some time, you can consider switching off the video as well.
Hello.
This is loud and clear.
Okay, thank you. So as we were just talking, on 18th October 2017, the rules were framed, and it was slowly, gradually moving up. The IBBA officials on 18th October 22, few days back, They were very impressed by the work we have done on. So they said few good notes and few bad notes. So I'll share first quick few good notes which they have mentioned. So first, what they said, to run IBBI IBC proceedings, RV reports have helped a lot. And they say approx 10,000 reports have come in last 5 years from SFA values in various cases. So they've given this data that 5,000 valuations have gone by, IBC cases have gone by. So we need 2 reports, so approximately 10,000 plus reports they have come. Then they share a latest important development. And what they said is on 8th October, recently, there was a meeting conducted by our finance minister with all regulators coming under the Ministry of Finance. And there, Ms. Sitaramanji urged all acts which are coming under Ministry of Finance that they should take registered valuer services only. And then she also said she requested other laws who are not coming under finance ministry, you may start looking into the services of registered valuer. So the regulator said, IBBI official said that we tried to, now it is very, though the government intent is very clear, but there are certain bottlenecks in legislature changes. So they are trying to see that how we can look into other laws very quickly. And one thing is very sure, values bill is not seeing the light of the day immediately. Valuation standards by government will not see the light of the day immediately, and they themselves says it will take time. So when things will take time, they'll try to find out some other ways how to move ahead. Now I got some messages that please sir, there is a typo in your slide, just change that. And that is intentionally typo has been put here as peer review, because it's not a peer review, should be peer review. So in the next slide, you will find the corrected versions. Now, the reason to put intentionally this is to let you know, you make entire report fine, put one thing wrong, the regulator will pinpoint that only. He will not tell you, you did 9 things right, and that is good. You did one thing wrong, I will leave you. It's 0 sigma, 6 sigma is expected from a valuer, that your report should be critical. You should not leave anything. So we'll quickly touch base what are the points and what are the considerations which regulator had, and that's why they are getting more and more stricter. So they started the objective of peer review because the profession was evolving, and whenever a profession is evolving, we had no benchmarks. So they started a purpose that let us have review of firms so that we can become better. The professionals can become better. If the professionals become better, the quality will be better, and we'll be able to give some value to the stakeholders. The IBC officials express concerns at places where many of the places in IBC valuations, the nil reports have been given by SFA, plant machine, other valuers. And according to them, by giving nil value, lot of companies get shut down, lot of people lost their jobs, and it creates a havoc. They say just because you are taking very conservative view that company will not get anything, being a liquidation IBC, you give value 0 may not be the right path. And that is the reason I'm sure you all would have got one email probably from IBBI has given a draft reporting style that what should be covered under IBC. So IBBI officials are more covered under IBC reporting as of now. They are not looking into draft reporting pattern of Companies Act and other acts. They have circulated draft which is open for comments and review. So one can look at what does the regulator is looking in IBC reports. Now, what is the objective of a peer review and what is the scope given to them? So each RVO is asked to maintain a panel of peer reviewers. The peer reviewers will look into the report and they need to give comment on what is the quality of valuation report. They need to ensure that the compliance has been done with Rule 8. And Rule 8 compliance becomes very mandatory for all of us. Though various RVOs have a standard that even if the report is not under Companies Act, but if you are using the designation registered valuer, you need to cover all points under Rule 8. you also need to look into various guidelines issued by regulators while drafting the reports. But the one thing they have been asked specifically not to comment on the value. So on the conclusion of value, they are not supposed to give opinion whether the share price is high, low, not right. That is not their job. Their job is only to focus on the process. How did the valuer did in arriving the conclusion? And of course, they need to maintain confidentiality. A peer reviewer cannot tell which reports he reviewed and who's the guy he reviewed. Generally, generally all RVOs send the report by masking. So whenever they send any RV report to a peer review, they try to hide the names of the valuers. Generally, try to hide the names of the company. As much as masking they can do, they try to do that. Only you can see the content of the report mostly. And documentation retention, now we all understand it is 8 years as per IC evaluation standards and 3 years as per our our valuation rules. In one of the valuation report, this comment was noted. This report is valid from 3 years from the date of report. Then RVO was supposed to instruct that this 3 year is nowhere related to validity of the report. Your report is valid for lifetime. You cannot say I issued a report today and after 1 year can be discarded. This 3 years was only for the purpose of making documentation retention, not for the validity of the report. And these all are extracts from various RV reports from professionals like us, somebody would have put in. Now, one issue which is pointed out in the reports many times, what practice you generally follow when I'm issuing shares to NRI? So I need 2 reports, Companies Act report and one for FEMA purpose. Should you give separate report on RV and CA literate separately, or one report you can do? What is the general practice house follows? So do you want to be environment conscious and print less papers and use one common report because the values is coming same generally, or you prefer generally using separate reports? So there is a different views adopted by different professionals, but IBBI and the regulators' views is very clear. They say we do not prefer same report, common report for both the laws. We need different reports for different acts, even though the value is coming same. And for them, the reason is that they say at times the regulation have different rules and laws. By clubbing together, it becomes difficult for us to comment on the process you have adopted. So the regulator preferences, you should not use same report. And they have quoted this in 2-3 peer review meetings which they had.
Sir, I have one doubt.
Please.
When the CA issues a report for for issue of share for IT purpose, sir. He
For
issues a
IT
report,
purpose. Yeah.
for IT purpose or FEMA purpose. Both the reports is issuing as a chart accountant. So I think one report holds good there. The authority signing in case of IPP and FEMA, there is a 2 part. One as an IPP registered valuer, one other as an CA. But in this case, income tax and FEMA both as chart accountant on the same letter either.
On the same letterhead, yeah. And that was done for even a listed company. So for a listed company, one CA who is also an RV, he produced a report for FEMA purpose and Companies Act purpose. Same report, same letterhead. You use his name and registered valuer and names chartered accountant on both left and right hand side. He put both the designations. So since it was a listed company report, so it got selected in peer review. And then IBBI, when it was given to RVO made an observations, and IBBI also confirmed these observations that we do not prefer one letterhead to be used for 2 different reports and different acts purpose. That's what their observation is.
Sir, I'm asking for unlisted companies. CA issues a one report, purpose of 2. One is purpose for FEMA as well as income tax. Same letter, same person, same authority.
I got your point, but what the regulator is saying, is both the laws have a different purpose. Both the laws have a have a different regulation requirements. Let's say, for example, in income tax, you can only do cost approach for a CA. You cannot do a DCF in income approach in income tax. Whereas in FEMA, there is no choice, there is no compulsion on which method you should choose. In FEMA, you need to justify why you are not using all three other methods, or which method you are rejecting. So just by putting one letterhead or one act, it is difficult to check compliances, because in income tax you have no choice. In income tax, if I'm taking a report from a CA, he has to take book value method. But in FEMA, I can take n number of methods depending on what is the situation demands. So that is the reason they were saying, yeah,
Means that
yeah,
the
please.
better each separate report for each enactment, because each enactment has got different expectations.
Yes, that's the regulator's view.
Thank you.
We were also used to do this earlier in 2018-19, but then ICRU did one peer review of one fellow colleague, and then they pointed out this is it's a concern. That's why we started doing separately. Okay.
Sir, but this income tax and FEMA Companies Act, we can understand because income tax is a different method of valuation. But for FEMA and Companies Act, the method may be same, no?
I
Still we should
fully
know.
agree. That's why I'm saying, Mr. Ravishankar, your point is very, very valid, and that was the logic I used to also follow 2 years back. That even I'm applying income approach in both the standards, my assumption will not change in both the laws. But then what the regulator view is, regulator says we want to fix the liability of RV and CA under different rules. So we don't want you to
Okay.
use the same standard. Now, let me, since you asked this point, I said fix the liability. One thing which I used to always think from last 3-4 years, I used to always think, because I'm also an IP also. So one thing I also always thinking, and I'm sure many of you would have opened IBBA website, you would have seen one thing very frequently. What is the one thing you see when you see IBBA website and see announcements? Can anyone recall what is the first thing which you see commonly?
Disciplinary case.
Sorry?
You mean disciplinary cases?
Disciplinary cases, absolutely. And I used to always think IBBA is so good and lenient that they are not touching valuers. So I was always feel safe. But then on 3 days back, I got the answer why there are no cases against, why there are no notices issued to registered valuers. And you'll be surprised. The reason is, and which is on the recorded said by the EG executive chairman of IBBI. What they said is, we do not have power to give you to levy monetary sanctions on registered valuers, because we got a delegated authority. So in delegated authority, IBBI, because when IBBI was formed, they don't have the direct power to control valuations. They were just thrusted upon till the time new body is formed. So they said we don't have power to levy monetary fines on valuers. And if I issue any notice, if a regulator issue any notice to valuer, then we need to either give him a suspension, at least for a 1 day, or we need to terminate him. He says in both the cases, it will be very harsh, where even the error could be very minor. See what happens in IBC proceedings. In IBC, we just issue a notice, and whatever bigger case may be, we'll put some penalty, okay, 50,000, 1 lakh, 2 lakh, 5 lakh, and monetary fine, and we can close it, because we can see how much money he would have made or the loss he would have done, and we can compensate that. But in valuation, since we don't have a power, he says he says you check your disciplinary committee proceeding. Whenever we would have given any notice to RV, his COP has been suspended or terminated. And this we have called only in cases where there is some bank has filed a criminal case against, not in RV Act, in other valuation matters. So that is the reason why IBBI is not sending any disciplinary committees. But they said we are trying to get powers, because then if you don't get powers, then it will not be good for community, because if we don't touch the community, leave scot free, you will go rogue. So that's the intent which they said, that we are lenient does not mean that we are permitting him. At one point of time they will question this. So one need to be very careful. Since the law is not sending notices, does not mean law is accepting. Once they got power, they will be come back to action. And those who go to IB website, that is only one thing every day you see. Every day average, they put one penalty on one professional, whether it be a monetary or suspension. So that we need to take care. Now, there are few comments which are written in the various reports.
And another thing is, sir, whenever they get power, they'll start punishing from the 2020 or 2019 onwards.
They can always do that.
That's
Retrospective.
what is happening for IBBA cases also, insolvency IP cases also now.
True. So there are certain comments which came in various reports, which I will seek your opinion whether you think it's okay or not okay. You can quickly respond. PM has given a report that this value of report are valid only for 30 days from date of issue of report. So can we give this kind of report to be more conservative? Probably no. We all will agree this kind of reporting we cannot put, because you cannot just give a caveat saying this valid only for 30 days. Your report, the value which you have given today, will hold good for lifetime for that day, but you cannot just give a caveat of 30 days. Now, this point has been discussed a lot in the IBBA peer review meetings. So the value has given a comment that I have no responsibility to modify this report for events and circumstances occurring subsequent to the date of this report. IBBA officials' point of view was, and see, we need to also understand they are not RVs, IBBA officials, so they may not understand the nitty-gritty of the comment we had made. So they were hardly pressing that this point should be removed, that RV cannot put a report that it is not his responsibility, it should be his responsibility to modify the report. That was IBBA officials' strong view. But then all RVOs unanimously in the meeting made they press upon this point that this is a very valid statement and should remain in the report. You should not discard this point. It should be remaining in the report. This point became very interesting. And the reason it became interesting in discussion with IBBI officials, this is a general caveat values give, that I'm not supposed to give testimony. I'm not expert, that you cannot call me to give testimony on the report. And I have a liberty to accept or decline. That's the statement generally values given a report. IBBA says, no, how can you decline? You cannot put this. But can anybody comment on this point? Should we put this in report or not put into the report? And IBBA officials were against this point, that this should not be put. Valuer should be asked to come. He cannot say, I will not accept.
So this is Ankit Guru. So I believe this can be put, like, you can't say that I will not go in case I'm asked, but you can of course say that the fee that I have taken does not include the cost of taking up the litigation, and in that case, this is how I will be paid for the litigation or for the expense that I make during that litigation.
Absolutely right, Ankit, absolutely.
No, but actually, sir, when a court calls you, I remember in Civil Procedure Code or somewhere, I remember having read that for attending a court is a pre-existing obligation. So you can't say I will not do something. No, I can't take again separate compensation for that. That's what I remember in the.
No. There is a fee given to valuers also for, I know specifically for land and building and plant and machinery who have been asked for court proceedings. The bank reimburses them for attending their court timings. That is there. That is, all banks have a policy that if you are representing on behalf of bank and giving testimony for whatever number of days you are going, they are reimbursed. So I know one valuer, land and building valuer, in one of the bank fraud case, he visited 100 days in High Court. For that, the bank reimbursed him. So there is a pre-defined limit. But the interesting point here is, this clause was already given by IBBI in their guidelines on caveat limitation disclaimer. So as I mentioned, see, the regulator may are different heads. Somebody would be issuing caveat limitation disclaimer is a different authority, a different professional. Somebody who is reviewing the reports are different. So they were told, sir, these lines are given by IBBI itself only. So if you see the guidelines given on 1st September 2020, exactly this is the verbatim para given in the report, that the valuer is supposed to give this kind of disclaimer. And the reason which Ankit has rightly mentioned, see, you are sitting in Bangalore and now a case happens in Delhi. And if a Delhi courts call you, you need to incur expenses to coming from Bangalore to Delhi. So the client should support to bear you. And that is the reason in most of the engagement letters, they write this nowadays in engagement letters. I've seen many values writing in engagement letters that if for any reason we need to go for expert testimony, the company need to bear the actual expenses incurred. So this should be at least covered for valuer's sake. So this comment will
Nice, sir.
continue.
Nice, sir. What I mean to say is that the reimbursement expense is okay, but you can't claim a fees at an hourly rate or something for that. No, can we?
No, that we cannot do. The bank has a fixed, like I know about the banks, they have a fixed per day honorarium fixed for you. So I will try to find out which bank had this policy. So two land values who were framed in one of the PMC bank case and one of the came, they were out to give testimony in PNB bank. So they were given. That is there. So this all RVOs have again argued strongly for this point, and IBB agreed that this will now continue to remain in the report, and that is the reason the caveat limitation, when they have put in, it becomes a strong point. Now, few things which was challenged by.
So ultimately, this disclaimer is only for the expenses will be reimbursed, no separate fees.
No separate fees.
Because I remember either contract act or some other act, one of these things will say that attending the court is a pre-existing obligation, so you can't be there can't be consideration for that.
No, but all the lawyers always ask, when they say lawyers means those who have given a report and that report you go and take to the court, they say because my time and efforts are involved. So I've given you opinion, and if you want me to come one time, they can generally do it. But if it is coming regular 10 days you need to go, then it's a costing for you. Anybody, it's a costing for them. So they generally charge some amount generally.
Sir, Ravisankar sir.
Sorry?
Tell me.
Sir, actually, as you said, attending a court is a pre-obligation, it is a compulsory. However, this is an arrangement between the client and the valuer. He is agreeing saying that I'll go, but whenever then he has to pay. If he's signing means contractually is agreeing. If he doesn't want to pay, then he can say that no, I will not agree for a fee, something like that. So I think.
So that's what I said, sir. So that's what I said. For a pre-existing obligation is not a consideration.
No,
So
today
I remember
agreeing, sir.
basically
actually,
in contract act consideration and all that. That's what it says.
So, but I do hope none of us need to come into that stage. I really sincerely hope and pray. Okay, so I will cross the bridge when it comes. So I doubt nobody will ever fall to that stage. But now see the grave concern. I mean to understand, as a valuer, we need to be very sensible. So if I'm taking a growth rate of 8%, terminal growth rate, can we justify that? Somebody can always argue, yes, I can. Somebody can, because if there is a thumb rule that your growth rate cannot exceed your country's GDP, that's a thumb rule, but there is no law. When there is no law, I can do what I want to do. If I can justify a rate of 8%, but what is important, my discount rate is 9.85%. The COC which I'm using to discount, the discounting factor is 9.85%, and my terminal growth rate is I'm taking 8%. Then generally these do not match. Somewhere there is a big gap. Then it looks like you have used 8% to arrive at a predetermined number. Now that is the question which they say that if you are taking 8%, you just cannot say I have taken 8%. Then you need to be, there should be very well explanation. They say based on your report, we cannot find out what is the reason you would have arrived at 8%. So they did not commented that 8 is not right. They say, but when we compare to 9.85 discount rate, it looks out of the box. So one need to have strong basis to identify how you arrived this number. One comment which generally was observed by an IBC valuation peer reviews.
Hello.
Yeah.
I just have a question here on a growth rate.
Yeah.
Usually growth rate is also supported by client's information, right? At what rate they are going, or it is absolutely RV's prerogative to.
It is always RV's prerogative, because client is giving you for 3, 5, 7 years, whatever the number of projections he is giving.
Correct.
But perpetuity growth rate client can never give, because each client will give, I will grow at 20%, 30%. Client will always go on a higher side. But that judgment of terminal growth rate is always in the hands of valuers. So a valuer says, I taken a call and discuss with the management, and management also agree. So let's say generally, I'm sure we all take between 2 to 5%.
Yeah.
So these are not my words or not what I've learned from my peers and all. So if you are a manufacturing company, generally 2 to 3% is a acceptable, defendable number. That manufacturing company grows at this rate. But if you are a retail company or if you are a internet-based service provider where your customers are mainly internet-based, 4 to 5% can easily be justifiable. That is acceptable number. But going beyond that, taking, let's say my GDP is 6% and I take 8%, then I need to justify how can I grow my country's GDP then in perpetuity. In long run, I need to follow what my country is doing. And the logic, the argument says, so this is based on Professor Ishwar Damodaran note, where everybody takes in the world this theory. But other argument is, if my product is doing so well, there will be people who will be copying and coming into the same domain. So my growth has to be rationalized. Until unless you have a monopoly. See, if you have a monopoly like serum product where only you can make vaccine, only you have the specific ingredients, then you can show a report growth. But if it is a general product, you cannot expect a growth more than the country's GDP. That's a general assumption.
Okay. Okay.
Can I say something on that, please?
Please.
Yeah, I think fundamentally one has to look at that GDP is based on a basket of different sectors. And different sectors will grow at a different rate. The GDP rate is the average of all these sectors, number one. So you need to look at under which sector that you fall. Second thing is, there will be some sectors which will outperform and some sectors will be laggards, but average is somewhere in between. If you are taking GDP directly right now for the terminal growth rate, you are undervaluing the company, and other way around. If you are in a lower side sector, then you are overvaluing. If you are using directly the GDP growth rate. Suppose if you were to in a sector which is in a better pacing than the GDP, you are supposed to take a higher than the GDP. But the challenge is, if this continues to perpetuity, the GDP will also shift to the higher number. But no one is able to estimate today what the GDP or not. But as long as the services sector is going at a particular rate, then that's okay if you take a higher than the current GDP, because after a certain period of time, the present value of that particular cash flow, that is anyhow has a negligible or an insignificant value to today's value. So GDP growth, it can be more than the GDP growth rate from that perspective only. Second thing is GDP growth rate is a function of typically the population growth rate plus inflation. Since you are not able to measure, and that's essentially the GDP value. Since you are not in control of that number, if you are really worried and you want to put a lower number of the GDP value, then you project that up to a period of time, next 10 years, 15 years, and then you take the GDP value. That is how probably you could make a justification, but taking as if today itself is the GDP growth rate is also a wrong number. Because today what GDP growth rate we have was 5%, 6% is a real GDP growth rate. We are taking all nominal GDP numbers, nominal growth rate numbers in the free cash flow. If one were to take the nominal GDP growth rate as the terminal value, then it is not even 5%, it is some 11% or 13%.
True.
So most of the valuers struggle on putting a right terminal growth rate, and that is the reason why, I mean, it's a practice, but someone has to really look at it. Ashwin Damodaran talks primarily about the international US numbers, where the nominal GDP growth rate is around 4-5%.
True. And in this report also, they did not question that why 8%, is it right or wrong? They did not mention that. What they said is, when you are taking a growth rate of 8%, does it supported by your discount rate 9%, 9.85? Generally, then you are saying almost your growth and cost is almost same, which generally cannot happen. There has to be a higher cost generally. So they say you need to justify how you're getting that number. And that justification was missing in the report. That was a challenge. So there can be, because if you talk to some big firms like Duff and Phelps and all, in some reports they have taken beyond GDPs also, but then they explained that okay, they have taken which industry sector data, and as he rightly mentioned, GDP is for a basket of various sectors. If you pick that particular sector, put that data, then you can justify. One concern which IBBI raised strongly was on IBC reports where we give liquidation value, and they say we have observed that people have just given straight away 70% haircut, whatever is of fair value, just multiply 70% and give that. That may not be the right logic, because they say it is just cutting short corners. One should not use this kind of approach in giving out a valuation of liquidation. And that's the reason they have come up with a concept paper, how it should be arrived or what you should work on. It's a draft paper they just issued a few days back. Now, we all understand risk-free rate has to be taken from government bonds. but one valuer has written based on 5 years of fixed deposit of SBI rate, I have taken that as a risk-free rate. This 5 years, see, we all know State Bank of India is one of the strongest banks of India, government banks, are likely not to fail anytime. But you cannot use SBI fixed deposit rate saying that that's a risk-free rate, because SBI also puts a markup on its fixed deposit rate. So that is also have a profit margin element to that. And that is written on a values report. And they said question. And the reason when I was asked to the valuer why you have taken SBI fixed deposit rate, he said I was supposed to value an instrument which is having only 5 years maturity, some 5 years fixed income security. For that 5 years, I did not find a 10-year government bond rate, so I taken a 5 years SBI rate. His thought process, at least he was thinking something. It may be a wrong thought process, but then regulator says SBI is not a government bonds related, so you need to take it, or you could have gone to Fibble database and find some 5 years bond rate, risk-free AAA bond, and taken that rate. You just cannot take SBI fixed rate. In one valuation report, it was said that the startup is risky and no comparable data is available. So we will take beta as 3. See, you take beta as 1, which is majority of people write in the report, we have taken beta as 1, which because of no data available, that also IBBI questions. That also IBBI says it is not a right practice just to put beta as a 1 by saying that no comparable available. But writing that taken beta as 3, when it is a very risky startup, that is not anyway digestible fact. One cannot put this kind of statements. As a valuer, we cannot make a comment in our report that company may touch this kind of turnover. When I'm giving my workings, my sessions, I cannot say company may touch this kind of turnovers. That is not supposed to be commented by a valuer. And that too, that number is not stacking up. So you are making a report that in this year, company will touch turnover of 10 million. Whereas in one quarter, the company has touched 10 million. So you need to be very careful whether the information you are giving, writing reports is not contradicting anywhere. So if you are doing a edtech startup valuations, you just cannot say I'm not taking market approach because there are no comparable transactions happened or available. So for a startup edtech, we all know there would be a Byju's, an Academy, Whitehead, and many other. And just recently we know what happened with JK Shah classes transaction. So we cannot mention in a report there are no comparable transactions or there are no transactions. So we need to write in a report, yes, there are transactions, but then you need to give a caveat. I looked into the transactions, but since the size and amount are different, so they are not comparable, or they will not represent fair value because their size is 500 crore, my total size is not more than 5 crores, then you can ignore it. But just giving caveat, we cannot find any transaction, shows that you have not worked on it, or you try to avoid doing this. By putting like this, okay, there was a Byju's and Academy, last some transaction happened, but we ignored consciously. So it shows that, okay, you have taken a right call. Now, see, Excel will only work the way you put in command. So in some reports, it was observed, few errors were observed. A lot of people put formula on taxes. So if I put on profit, so if I put a profit, then next line I'll put 0.26 or whatever rate you put and put a formula, and then straight away you get a tax number. Ankit, yeah, thank you. In certain numbers, in certain Excel sheets, it was noted that there was a loss, and then formula was applied straight away, and loss will give a negative loss. So it was adding up. So you cannot have when you have a tax loss, you cannot show as a cash receipt. And people have shown that as a cash receipt in the DCF, because normally you show cash outflow of taxes paid. They have shown cash receipts. So it was a formula error, and one should not blindly rely on formulas and put in. If you are giving a valuation report for a particular day, let's say you are saying my valuation is for 31st December 21, you have all given predictions in your financials, but nowhere you have mentioned on the financials of that day. So for April to December 21, the picture is nowhere presented. At least the balance sheet of 31st December should be presented in the report. Otherwise, reader is not able to find out what is the current situation. You've just given one Excel sheet of projections from 20 to 2 year onwards, but nothing on 21. So regulator says, how can we make out what the value you are giving is actually attributable to the current balance sheet? So I need to see what is my current balance sheet showing, and then what value you are giving to my current balance sheet. So that should be mentioned. Now there is a very golden rule of drafting, because all this peer review, what they will look into, the peer review will look into the reports you have presented. And there is a golden rule of drafting a report. And the rule is very simple. Write what you do and do what you write. If you follow these two lines, none of the report could ever have a challenge. So whatever I have done, if I have put in the report, that is the basic essence. And whatever I am writing in the report, I should ensure I do that. So when we started following this rule, there was a startling recovery happened. So in one of our, so we work with a group of professionals. So one of the reports generally we write, if you see, we write in the procedures performed, reviewed MOA and AOA. That's what we do. So one of our office colleague presented a report to me that this is my report and I've done this. And I was reading the report as a reviewer. So I said, look, in your report, you have written, I've read memorandum and articles of association. So show me a copy of MOA and AOA. He said, no, that I don't have. I said, you said you have read. Well, to sab likhte hain, tum bhi likhte hain. So when I said, no, if you are writing something, we need to have it. And that was, and I had a hinge that no, we need to look into that report. So the client has asked us to do a valuation for a pet company. So they are a pet food products. So after Ratan Tata has taken over some stake in dog food companies, a lot of startups open that we are also sell pet food products. We'll get a huge traction. So they gave all projections based on food in the pet foods. So when we looked into the MOA and AOA, we were surprised. The business objective was only IT industry. And when we asked them, where is your food product income? They said, oh, we missed. So this is the query we asked the client, that when we reviewed your MOA, AOA, your objective is IT consultancy services. Nowhere in your business clause you are saying that you will work on the food pets business. So then we asked them, why are you not considering any IT income and you're considering only income from pet businesses? Then client came back and say, oh, it was our mistake. Our business is only to render IT consultancy. We discussed with management. Now very soon we'll incorporate new company who will sell pet products as a basic object, and then we'll come back with the valuation. Now, had we not have read the MOA, we might have done the mistake, and we would have done the mistake. And because nobody, the client is least bothered what you're writing in a report, he's bothered on the fair value of equity you are giving. So one need to very, very careful what you are writing in a report you're actually doing or not, though it may sound as mundane as it could be. So one need to read and write what they're doing. Now, what is the challenge happen in reports? The rule 8.3, which is a very essence of any reviewer or any value to report, we need to consider all the points. In 2017, there were certain points which are not in this rule 8.3, which were added later on, which a lot of people miss in adding. Let's say, for example, base of value and premise of value was not there in the initial rules or intended user of valuation. It was not there in the first rule which was presented. So it got updated later on, and a lot of people who have not updated their reports miss to add these points in their revised reports when they issue later on. So clause C, D, and F need to be taken care of whether you have actually put in your reports or not. Now these are mandatory clauses to report. Similarly, some new clauses which were added. What is business interest, significant assumptions? So these clauses were not there in the reports earlier, but now when you are putting a report, this need to be added so that whenever a peer reviewer review reports, he does a checklist. So I know many peer reviewers of various RVOs, what they do is they are given by RVs, their respective RVOs, checklists. This point A to Q, they check on the report whether these points are actually covering something or not. If it is not covering, then it becomes a negative mark in your report that this is not covering rule 8.3, because rule 8.3 is the essence which any valuer and RV and IBV looks in. Yeah, Gaurang, please.
Hello.
Yeah, Gaurang.
Yeah, sir, I have just one question with respect to MRLs. So supposedly, if a company, it's a holding, it's a subsidiary company which is going into certain transaction, and that subsidiary company has a negative net worth. Okay, so if we value the company on a going concern, or maybe on a stand as if basis, the company, the valuation is coming negative. Now, because of certain transactions, the holding company has given the assurance that in case if there is any solvency insolvency cases
We
appears,
will
not
infuse the fund.
solvency cases appears, the
We will
holding company will infuse the fund so as to obligate the debt.
Correct.
Okay, can we put this MRL? We are taking this MRL from the holding company, from the management. Can we put this in our report also?
You can put this in a report also, in a significant assumptions. So in the significant assumptions, you can put this.
We can, no?
Yeah, in the significant assumptions, you see, if you just let me go back one slide, just give me a minute. So in the significant assumptions, you can always put in this, which is a newly added feature in latest valuation rules requirement, that you can put that you are relying on that, because in case of solvency, the management, the holding company is supposed to fund as the confirmation they've given. So that is acceptable.
Okay, sir. Thank you.
Thank you. Now, we all know about projections, and it is very famously quoted that more fiction is written in Microsoft Excel than Microsoft Word. That is.
Sir, I have one doubt.
Please.
Sir, you said in the previous discussion, if we are doing a valuation as on 31st March 22, then we need to comment on the present financials of the current year. Projections
Somewhere you need to disclose. They say somewhere you need to disclose. You have not even disclosed anywhere in the. If you don't want to comment, that's fine. But somewhere you need to put the financial status as of this year. So what is happening? What is the regulator concern? Understand what is the regulator concern is saying. As a reader, I am not sure what is the 31st December actual balance sheet position. I don't know.
But
so
I
you
don't
are
even,
giving,
sir, we don't get now, assuming that if we are doing an valuation today, I'm saying valuation report.
If you're doing a 31st December 2021 valuation, okay, so you will be taking the cash and bank. If you're using DCF approach, you will be taking numbers for starting point with the 31st December number.
Yes, sir.
So that number, so it is not an audited financial, I understand, it would be a management account, but somewhere there has to be some structure of data. So what the concern is, I need to know what is the actual position on the 31st December vis-a-vis what number you are giving. So let's say was the example is.
Sir, 1 minute. What is the expected? Now, assuming that I will take 31st March 2022, we are doing a valuation. As on that, cash and bank balance is 4 crores. Now, I am giving a valuation report as on 22, signing today. Now, if they give a provisional financials up to say September, I'll say that report as on 30th September. They don't provide. So now I can only say that this is a report as on the date. Subsequently, there are no significant transactions. Can I say like that, or what is the
Yes, you can. Then you can say that. Then since you have not got the data, then you need to write, I got only 31st March data, and management assured that no significant changes happened. So that is being taken as a base, and that 31st March number should be there.
So, but normally when we say valuation report as on 31st March 22, it is understood that as on the date on subsequent transaction not considered.
No. The question which what the observation was, first you decide what date you want to give a valuation report. The asset of valuation.
22.
Sorry?
March 22.
If I'm doing a valuation as of 31st March 22, I'm giving a projections of next 5 years in Excel sheet in the last annexure A. You're giving a projection of 5 years. How did your EBITDA move? How did your changes in capital? Everything you're putting.
Yes, sir.
But nowhere you are giving the balance sheet of 31st March 22. So I'm saying as on 31st March 22, your fair value of shares is XYZ, whatever the number you are giving. But somewhere I need to know the actual balance sheet, whether it is in negative 1 rupee, 10 rupee, 5 rupee. So I need to compare my book value, the audited number or unaudited number is giving me negative net worth or whatever number, and how much projections you are trying to get a number. So that's the comparison they wanted to see, that you're talking of 31st March 22, but not given data of 31st March 22. And that is the reason they need to say, you need to give company details basic at least. You are not supposed to comment, that is fine, but give me a balance sheet at least there. Or management account at least.
Sir, in that case now, as per your say, what is a better way of reporting? Sir, we have to write a NAV as on 31st March 22.
No, don't write. Just paste the balance sheet, the financial extract, the financial summary presented, the financial. If it is audited, the audited financial summary is like this. Just
as an annexure 2.
Yeah.
As an annexure 2.
Annexure 2. Yeah, just that presentation. Fine, sir. Thank you.
So can I ask one question, sir, regarding the previous side, the
Please.
contents, is it
Yeah.
mandatory to put all the
It
contents?
is
Sometimes
mandatory. It is
sometimes
mandatory.
it
No, I
doesn't make
understand.
sense sometimes.
Ganesh, I understand your point. That's why I said in the initial beginning. So in the initial beginning, what I said is, I'm RV. I'm issuing a report which is not to be used in Companies Act, or for some other client has asked me to give a internal report, not for Companies Act. Okay, just for internal management, I need a registered value report. Even then, the regulator is expecting your report should follow clause 8 subsection 3. So this clause 8 is on between valuation rules, and all the peer reviewers has been given instruction that when you review a report, you ensure all these points have been covered or not. Whether you are writing in separate columns, separate paragraphs, that is immaterial. Somewhere in a report, you need to mention all these points that, okay, there was no caveat, no limitation, whatever you would like to do. So these points need to be mentioned somewhere in a report, may not be in a particular heading wise, but somewhere this need to be touched upon. Like, for example, if you're doing a valuation of, let's say, leather industry, leather company. So you need to write some para, 1 para, 2 para, 3 para on industry perspective. And so what the people are doing, they just go to ibef.org website of IBEF and take a data of leather industry and just paste that. So somewhere you are trying to put something so reader can get idea what is the industry doing, what your company is doing. At times, certain data are redundant or not relevant in your report, but still they expect you to put that in your report. That's the expectation.
Which is actually I'm questioning as a peer valuers when you're going to this RBS whatever. It's a reverse question. It's a stupidity, right? You are trying to put a copy paste stuff of that stuff for something, a report which is of so valuable in nature. You are making it invaluable by putting all this junk in the report.
That was the question I asked. I said, okay, for Companies Act, if you want to put mandate, fine. I said, I'm using one report for my client internal purpose. Okay, it is just client said, okay, give me a fair value. It will not be used for any compliance purpose. It is for internal discussion. I'm sure many of you would have got certain clients requests like this, that just a fair value only for internal purpose, so that I can do a deal with a buyer and seller. It will not be used for compliance purpose. Even though the expectation is in that scenario also your report should comply with these kind of points, which to me is illogical. Personally, to me, it's illogical.
No, is this where I was coming from? Is this something that some of the peer valuers have said that a compulsory karna hai, or where is it written in the as a gospel? This is how it has to be written.
Okay. So this is under Rule 8.3, Valuation Rules 8.3. They said the report should contain these factors. Let me see if I can open. Just give me a minute. If I can open, just give me a minute.
But any of the such regulations have to be read in the context, right? I understand that it is written as should. That doesn't mean that you blindly write up things. My question is it framed up by some of the peer valuers?
No, it is not framed by. No, they've been got the mandate that based on these valuation rules. Let me just.
Yeah, I was looking for such mandate. I wanted to know if RBI has given writing. Blindly follow this. I was trying to understand.
Yeah. That RBOs have given, and I'll come. Just give me a minute.
Sure.
Just give me.
Sure. Thank you, sir. Thank you.
See, this is the basis from where they are looking for. See, this is a valuation rule. So what they say is that when I'm doing valuation, when the RV is doing valuation, he need to follow this conduct. Okay, that is mandatory. So this is a non-negotiable for them. They say it is mandatory. There is no leeway allowed here. So clause 8, they are mainly concerned on this point. And here they are taking the word shall as a gospel truth, that it is written shall, it has to follow. So what they're saying, the value shall in his report state the following. So even it is not valid. So I got a point. So assuming there is let's say something which is not relevant, something which is irrelevant, inspection or investigation, something, any point which is not relevant, like I don't want to give any restriction on use of report, let's say for any reason. They say no, these are checklist minimum you need to mention in your report. Let's say my first funny question was this date of report. So when I'm signing on first page and last page that I'm signing that report and putting date, they say no, you need to write specifically the valuation report is issued on this date. So when my top line first page and the last page put my date numbers, date details, they say it is not written there. So at times they are taking this line by line. Okay, it is not there. So then what we did, and I'm not saying what I also did, and I've seen many reports now, they made standard report like this only, so that this point cannot be missed. And whenever the peer review comes, they can easily justify, look, it was there and we did that. That's the point which people are following, because I don't want any reviewer to come and say, Sumit, you have not done this. So I say, okay, you be happy. I put everything on this. Now you cannot question me. And that is the reason they are blindly following, and they've given instructions. So since I am also a reviewer in 2 RVOs and other RVOs which we talk, so they have given a written instructions that this should be followed. I can vouch on ICI, ICSI, ICMI, IBVA, Divya Jyoti, and some other RVOs with my friends are reviewers there. They have given strict letters and similar like this, that you need to do that. So these are certain unpreferred things which we need to do.
Thank you, sir.
Thank you. Coming back to the point of projections, we all understand it is haywire at times. But can I? So at times, many of you would have felt in your valuations that projections looks unreasonable. You would have felt. But can you give a caveat like this? Just can you give a caveat like this? Just read one first para, and let me know if you think this caveat works for you. The management. Dragon layout. So the first para is, the management assured us that the company will launch this portal within 8 to 10 weeks internationally. So let's say there's a startup, e-commerce startup, and they say, take example of Dash Cart. So we are making a Dash Cart, and in 10 weeks we'll launch a portal internationally, and the portal is pending. Now see the line the valuer is trying to put, and see whether would you like to put that line. So the valuation is completely dependent on the assurance given by the company. If the company fails to launch the portal within this week, and if the company could not bring, the valuation may affect. Okay. Further, the valuation shall be invalid if the company or director could not fulfill his assurance, commitment, or facts provided to us. What do you think? Is it a safe way to put this kind of disclaimer? It is your call. Do you want to be that conservative? But the moment this report went to investors' hand, they blasted the value like anything. You know, everything is a commitment. But if you say, no, the launch the product failure, then don't do that. Then give a qualification. But here you are writing somewhere in a very small line, which you could not read. It was written in 5 pages of disclaimer. So this, if you have such concern that you are not fulfilled on the surety of the data given by client, or you don't have faith on the numbers, write on a prominence. So if you want to write, it should be in prominent. You cannot just put into the garb of pages. So out of 14 pages, 9 pages were report and 5 were caveats. It was just put somewhere in caveat which nobody could read. So that's the reason one need to be very careful and do not write. And IBBA says we cannot give a negative assurance now. Now we need to give mandatory positive assurance that I got sufficient time to carry out the valuations. That's what they need to know. Now these are the procedures which again in the mention in the guidelines, that what the procedure should a valuer follow by doing that. So try to see whether you are matching this kind of procedures in your working papers at least, if not in report. Now, few major findings which started was, one was, so I'll quickly rush on major findings. What are the issues they noted? I need to give information on the asset to be valued. That detail need to be valued. My identity need to be mentioned, that what is the identity of a person who is doing the valuation. So this is mandatory. And in one NCLT case, the person used some other details. He put somebody else's registration number in the report, which should not be there. What is the purpose of appointing authority? So you are doing a share issue, by doing an infusion of funds valuation, and you are writing section 232. So that does not work there. For section 62(1)(c), your correct section quoting is mandatory. Assignment, which IVS you are using, that should be used. That should be mentioned. People are not mentioning which IVS. So though I understand as a RV, you can say I'm following my IC, whatever RVO standards, but somewhere you need to specifically mention which standards your RV is following. This date of appointment valuation is mandatory. They say it is not mentioned in the report. This is mandate, should be done. You need to give a reason why you're not using other approaches. Just by saying I will use DCF or I will use only NAV, you need to justify reasons. Suppose the client has not given data of DCF, then it becomes a reason for not using DCF approach. You cannot make projections on your own. So somewhere that reason has to be given in a report. I'll skip that part. I'll take there.
Actually, Sumit, I just want to have a point here. Few of the members are of the view that, projections can be made by the valuers in discussion with the, management, and they have suggestion. One of the discussions in the BVA,
I
senior
was
members.
also part. No, I was also part of that meeting. I have also gone through that. See what happens in India. They will not permit that in India. The law will not permit that for a reason. They will say your independence is impaired. That's the reason. In US, it is permitted. In US, it is permitted, but there is a condition. So one of my colleagues who work for certain US clients, what they say in US, they will see what is your qualification to make projections. So let's say, for example, if you are doing a valuation of a hotel industry, so do you have any background on hotel industry? If yes, then you can make it. So I have not done any valuation of hotel industry, and now I start making projections, they will question. Or they will say, did you take a help of any hotel expert? So they say for making a projections, you need to have that knowledge. You may not be a CA, they are okay. In US, it is not necessary to be a registered valuer. Anybody can do a valuation if you can show your credentials that, okay, you have this much of knowledge based on experience, the code permits that. So similarly, like American Society of Appraisers, anybody can become appraiser. You need to have the demonstration. But here in India, they say if you are making a projections, then it is your independence is impaired. It is like the maker and checker concept. So if you are doing an accounting, you cannot do the auditing. That's a concept we follow. So here regulator will not permit you always. But outside India, it is permitted. And that too in a very limited sense, where they have given a data and you want to tinker the data. You're not happy with the projection, then you can do some modeling into that data. You can take the assignments for that. That is fine in outside India. But here it will be a challenge.
So are we saying we cannot do adjustments to the numbers being given by the client?
What they are saying, you can do adjustments in the discount rates. If you're not happy with the projections, you should not tamper the projections.
No, but that's a ethos, right? Discount rate is the last thing. First is when you're studying the industry, you're doing the industry review, right? So if you're only playing on the discount rate, it is an erroneous way, because that's not the
But then data, I agree. But client is making a projections, and if he is not willing to accept, then the report is ultimately for his purpose, and he says you are not using my data. Then if the client data are not relied upon by client itself, so client
you give it back, na? Say after you adjust.
Correct. You give it back, but then the client should accept that data. So you got a data, and the client has given extraordinary growth rate beyond the industry, and you say this growth rate is not achievable, and you made the adjustment and tell to client, and the client is okay to adjust it, then it is fine.
Normally in the practice, what they do is client will share the projections in draft. We'll not agree. We'll make all the changes, whatever to meet the requirements. Afterward, we'll complete the evaluation. Then we'll share that projection as in the form of MRL. He will sign. So basically, he takes responsibility. I think that should be fine.
Yeah, that is fine. That is fine. So like what the client make a mistake always is they will not show anything on capex. So yes, so they will not show. But then capex has to be there on the industry pattern. So if you all see that discount rate, the depreciation is 25% in 4 years, you need to have a new set of assets generally. But client generally ignores that. So that kind of logical changes and all that you do, it's fine. But what I'm trying to say is the client says, no, I'll not touch my number, and you also now have right to touch my number. Then I cannot issue a report without accepting him that my number. So if not making agreement, and then that should be okay. That should not be challenged.
So is it a MRL formally signed required, or the email
communication? Is not required. Email communication is fine. As per valuation standards, MRL is not mandatory document to be taken.
Email communication is fine.
Email is fine. Yes. Thank you. So the first peer review happened on.
Apologies, sir. I have one query. Normally, when we have, this is actually with regard to one of the scrutiny proceedings as well that I came across. Now, we have.
I'm not able to hear Methli after we have.
Revenue for high growth companies now currently. Sorry, hello? Hello? Can you hear me, sir?
Yeah, Mithili. Can you repeat the last part of the question?
You can hear me? Yeah. No, now in case of some of the startups which are in the sector of there is a major disruption, the revenue numbers are kind of really steep and all that. So there is a certain level of risk that we take because we don't know how the sector will actually flare up in order to comment. So in those cases, are we required to sort of comment on the revenue projections, or is it okay to give a disclaimer saying that it is dependent on the ability of the management to give these projections and whether and if this is considered reasonable, we have done a basic analysis, and if there is any differentiation which would result in a different valuation, is that okay to have a,
that is
sort of a
in my
caveat that
view,
way?
no, in my view, that is not okay. And the reason why I am taking this view is IBB has given a guidelines on 1st September 2020 on caveat limitations. There they have given specifically that now you cannot give a negative assurance. There you need to write in your report that you got sufficient time to analyze the projections and you review the assumptions made by management, and you are okay with that. So I cannot give a caveat saying that it may work, like the slide which I showed, where the client has said in the report that if the management does not give, it will not fail. So if there are assumptions, you need to give significant assumptions, you need to mention significantly. But you just cannot say that since it is a risky industry, so I will not know that it will actually fruitful or not. So we all know that as a valuer, we are not guaranteeing that it will actually eventually it will occur or not. But suppose it is a very risky startup and very new, unique startup, then my discount rate can be high. It can be as high as 30 to 50%. Because based on the model, there is a model used in US where they go on a seed stage startup. What should be the highest discount rate? Average rate they've given like 30 to 50. For a first round startup, what could be the discount rate? That's a range they've given. So if you are, let's say normally your discount rate is generally between 15 to 20% generally. But if you want to take 30% or 40% for first few years, that is also fine. So I've seen certain international reports where they've used two discounting factors. For 5 years, they are using 40% discount rate, and for after 5 years, when the company stabilizes for a startup, they use 30% discount rate, and they have given justification why they have used this kind of discount rates. That's a globally acceptable practice.
Okay. Okay.
Sir,
Because
regarding this,
one thing I would like to share, in one of the scrutiny proceedings that they have done, the assessing officer actually brought a reference to this, saying that it is quite ridiculous to see that the valuer doesn't back his own projections. In this regard, we also junked the report, just like how he has a caveat. I decided to junk the report, and I would like to see an analysis against the actuals the company has had.
True.
Sir, I have one doubt on this MRL.
Yes, sir.
Sir, you said MRL is not mandatory. Though it may not be mandated by law, but actually as a valuer, since we are discussing at BVA, I think we must have a practice of getting MRL, because client keep on sharing information multiple times, multiple pieces. We do some changes as we discussed, some changes. So I think once you take MRL, that is a standard document.
No, I do not have any doubts on what you're saying. It is the best practice. But what the point is, like for example, in audit it is mandatory to take MRL. In audit, without MRL, it's a non-qualification. If I don't take a MRL, my reviewer will question me that in audit why you have not taken. But in valuation, if I'm not taking a MRL, it is not it's not a law non-compliance. It's a best practice, and one should always take, because nobody can question me. So nowadays, it's email. No, I'm coming to the point. So at times we have certain clients who questions. He says, when I have given you email is a document. And I'm talking about MNC clients. See, mid-size, small client can easily do whatever you want to do. But when you talk to matured clients, more matured, they say email is a legal under IT Act 2000. So it is a legal communication, except this, I'm not going to give it signed for various reasons. So if that email should work as a MRL for me, the numbers should be there. And if it is a timely emails, it serves you. Where it is a backend email, you did a valuation and now backdated email cannot go. So hard copy works always fine. So if you have that and you're fine, that should be okay.
Yeah, sure.
Should be good. Now, 14 February is always known as a Valentine's Day and Day of Love. But that day, the first meeting of IBBA peer review happens. IBBA called a meeting on such an auspicious day all RVOs were called in 2020 before the COVID just stepped in, and they were very unhappy with the quality of reports because this is the first time the reviews happened, and the errors which came were very blunders errors came, and IBP did not like it all. And the logic they said is, we understand the phenomena between the values that it is a subjective. So we understand valuation is subjective, but that does not, and this is written in IBP minutes, and this very scary language they use. This means valuers can play with the numbers, can exercise the judgment to accommodate end result intended by the recipient. This is something harsh on valuers, and they say why we are saying this. We want to be objective science, not subjective science. And the examples to support that why they made such an arbitrary assumptions is growth rate assume 10%. Again, they are not questioning that 10% is not right. What they are assuming is somebody need to mention that, yes, somebody should mention that why you have taken 10%. 10% can be a right call, but somebody needs to mention that why 10% is a right number. You cannot just say, I feel it is 10%. Terminal growth rate 5%. So everybody takes 5%, I am fine. But you need to give a basis that, okay, I studied my industry. If it is a manufacturing industry, generally do not grow at 5%, generally, depending on which sector you are. Beta cannot be just say it is 1. If there is certain company which has no data, then it's fine. But you are doing, let's say, edtech company, and edtech company has betas now available. So that it is a simpler approach people follow, which is not acceptable. So a lot of people argue that let me take beta 1 and then let me increase the discount factor, specific risk premium. That is not a right approach. Apologies. You cannot say that if you have a product life cycle is indefinite. Let's say you're doing a brand valuation. You cannot say life is indefinite. Every product generally has a life that need to be considered. So there are certain assumptions they question that they say whenever we do a valuation, the report is questioned on various parts. One of the part is it lacks advocacy. That is lack of independence. One would be valuer may not have sufficient technical competence. One could be negligence. They say the majority what we observed was negligence. They say we do not get many cases where technical competence was a challenge or independence was a challenge. Majority of the places negligence was the challenge which we observed during the main peer review by reviewing almost 200 plus reports. And what they say is, what are the key observations they observed in negligence? Your scope of work is not clearly defined. Your evidences are not clearly explained in the report. You do not mention which methodology you are applying and how it is relevant to that methodology. A lot of people have copy pasted reports from somebody else and their methodology they have mentioned in the reports without reading. Errors in grammar, I am okay with the errors in grammar because English may not be the first language for everyone across the India, so that can be okay. But errors in math is not acceptable at all. And I'll give you one screenshot where the errors in math happened. So error in math is not acceptable, and few errors in math happen generally which make mistakes people are. One would be on changes in working capital. So there are 2-3 errors noted in changes in working capital. A lot of people take cash and bank also. Generally, your first time valuers, they take cash and bank also in working capital changes because they just put a formula in balance sheet current asset minus current liability. They forgot to remove current cash and bank from it. Second, at times where the positive movement should happen, they are showing as a negative in cash flow and vice versa. So whether the movement in working capital should be in inflow or outflow, that need to be very well taken care of. So do not rely at times, all times on Excel. Contradictions in the report are many. You write something on the first page that company is growing, will grow at a certain rate, and then next day you're showing a decline rate, or you are saying industry is going down and company you are showing very high growth rate. So contradiction should be taken care of. And if it is there, you need to explain. Assumptions have to be mentioned clearly. These are certain observations noted in first. Your conflict of interest disclosure should be shown separately. Normally people mention that, okay, I am independent, I don't charge fees more than this, but you don't have any conflict of interest that need to be specifically mentioned in the report. Purpose is mentioned, but who is appointing authority, that need to be mentioned. Even though the appointing authority will be board of directors in private limited company, you need to mention that they appointed me in important cases. Dates have to be mentioned. Dates are appointment date, valuation date, and report date. Standards mentioned was mandatory. Caveat limitation has to be mentioned. And since this report this came when we do not have the guidelines on caveat limitation issued by IBBI. They issued on 1st September 2020. So before that, people had no standard working, but later on they put this kind of workings. So now it is mandatory after September to put caveat limitation disclaimers in your report. You need to indicate what are the factors that were taken during valuation. So suppose in case of DCF, so what factors you have taken in DCF. Conclusion have to be mandatory, given separately in one specific paragraph, that based on all the procedures, whatever you perform, what is the value. These kind of should auto-pilot in your report. It should be separately in the report so that reader don't need to put efforts. Restriction on use of.
Sir, can I ask one question on the appointment authority?
Yeah, please.
See, what happens is in a MNC company or where the foreign investors company is there, typically they have this appointment of professionals, various requirements. A board meeting is required. Okay. Now they don't conduct board meetings or an audit committee. They don't have typically this regularly happening there. Investors coming who are the directors. So as long as the CFO signs, is that good enough, or again you need a board approval only?
See, if it is a issue of Shares Companies Act requirement, then board approval is mandatory. It can be one standard appointment. Let's say on 1st of April, they say, okay, we appoint Mr. Ramanani for doing our valuations for this year. We appoint him as a valuer for our firm. Then that can be still argued. But for, let's say, normal issue of shares, section 62(1)(c), if I say CFO has appointed me, then the regulator will challenge, because the appointment should be only either audit committee or board of directors. If
for example,
for your internal valuation, let's say for Ind AS valuations, like the MNC has an Ind AS compliance, and for Ind AS they need to do purchase price allocation, impairment testing, or any other valuation, their CFO appointment is acceptable, because then this is not for issue of shares, it is for accounting purposes. Then that can be still justifiable and arguable. But in case of your fresh issue of shares, getting appointment from CFO will be a question mark. Until unless the board has authorized CFO to appoint. At many places, the board authorizes the management to appoint. The board is given power to management to appoint. Then you can still take that view.
Sumit, I got one query.
Ramaniji, I think his query is still queries there.
No, thank you, sir. I think you answered it correctly. There are certain valuations which are statutory, like issuance of shares. Understandable that it's a board requirement. However, there are certain valuations of accounting or compliances where you are saying that can be still signed by CFO, which is good enough. So that answers the question. Thank you, sir.
Please, somebody else was asking something.
Sumit, if the report is for internal purposes, then can the CFO appoint the valuer?
Absolutely, he can do that.
Okay, thank you.
Sir, but in some cases, some merchant bankers are given the wholesale contract, and then they are giving us the appointment letter.
So that is that they have questioned.
No. So they are actually showing us a resolution where the board has authorized them to appoint valuers and everybody, unnecessary people. So is it valid for us?
If I take appointment letter from them, so what I understand, this is a practical situation and practical problem. So let's say ex-merchant banker has been given mandate by a company that please get a valuation for FEMA also and get a valuation for Companies Act also. Your consolidated fees is, let's say, X amount. Now merchant banker is say, I will give you X amount of fees, you need to work for me. So what we need to do, at least in this case, is tell merchant banker, at least fine, they've given mandate to you, get us a EL signed from company. Do not mention your fees. So because what is the problem of merchant banker? He doesn't want to know how much fees he's getting or how much fees he's paying to you, to the company. So remove the fees part, and you can say fees will be decided subjective later to the completion of engagement. Something like that you can put, and get an engagement letter from company. Getting engagement letter from merchant banker and then issuing report to company will be questioned. And this has came many times to various RVOs. And that's the way they understand that, okay, your appointment is fine. They've done a tri-party board resolution, but get a letter from company without mentioning fees and all, just so that you get authority. That is the only thing, and which the merchant bankers are now accepting. They say, as long as you don't mention fees in that, we are okay with that. So that part they will do, that compliance they will do for you. Even if it is just mentioning that this will be registered value, you will present report to us. That should be okay. Now,
Sir, the fees part, can we leave it completely blank, or we
yes.
say
No,
fees
we
is
can
as per?
No, we can leave it completely blank. We can say fees will be decided based on the time and hours spent, and then we'll quote accordingly. Will be discussed later as mutually agreed. We can put that.
Fine, sir.
It is not mandated to mention an exact number.
Okay.
When we are doing a valuation, especially of liquidation, we need to understand liquidation valuation should be done as per IVS standards only. You cannot do a liquidation value in IBC without any other standards, and they're very clear standards. They have noted that we have given stereotype notes for all assets. So if I'm writing line by line comment, one standard asset note was given, which is not acceptable. They just applied percentages on the numbers, like fair value is coming 100. So let's say liquidation value should be 60%. That is not right approach. Figures are computed based on provisional balance sheets. So if I'm computing figures on provisional balance sheet, I need to somewhere strongly, prominently display that these are not audited numbers, because provisional are supposed to change, and any change in provisional balance sheet will change your valuation drastically. So you need to mention that these are strongly based on provisional numbers in absence of audited data available. And if any change in provisional to audited, the valuation will have an impact. That disclaimer, that assumption, you need to show separately. Now,
sir, my doubt.
Please.
When you do the valuation based on projections and also current year provisional, we take only closing cash and bank balances as in the valuation report. Assume that if the turnover changes from 100 crores to 95 crores, so that may not have impact on what numbers have adopted. Am I right, sir? Will there be
No. It will be fundamentally changing your all numbers, because your changes in working capital will move a lot. Because the first your changes in working capital depends on the 31st March provisional numbers, right? If the number of changes, your entire WC will change.
Working capital will have impact. Yes, agreed.
Yes.
Sure.
Now, in a lot of IBC reports, people take a negative approach and pessimistic approach that already there's a margin money given in the bank, and they show it as a value as a nil. They write a disclaimer that since the bank has given a loan to the company, and company has defaulted giving loan to the bank, so the margin money will not be having realized any value, so it will be nil. Are you okay with this kind of comment in IBC report? Anybody has any view on this?
Sir, legally is not correct, but in practically, unless I clear the margin money, you will not.
What IBB has taken a strong stand on that legally it is not correct, because in case of when CIRP proceeding starts in, it goes into the waterfall mechanism. Then bank do not get a right to adjust on its own. Then it goes to the company's kitty. So the distribution happens as per the waterfall mechanism. So you cannot just give a valuation nil. You need to say it will be value, because the amount will go back to the liquidator or the RP. So that factor we need to take care of. Earlier, we were also doing this. So let me also say, when in 2018-19 we did valuations of IBC, we were also giving nil, thinking that how bank will pay that money, because bank will deduct against its loan. But then as per law, legally, bank cannot do that. It has to go back to the committee.
So one addition. Yeah, so one addition here from our experience with insolvency cases also, we find that in many cases, the balance sheet is an own balance sheet. Margin money is appearing in the balance sheet, say in 2018 balance sheet, 19 balance sheets. And many insolvency cases, we see that the margin money has actually, is adjusted by the bank before the CIRP commencement date. So like out of maybe 100 cases, maybe a good probability would have these balances adjusted as compared to others. So this assumption that it will be adjusted is only present or only put where we are not able to get, or the RP is not able to get any confirmation on the existence of these margin money deposits. So the RP during this entire tenure is in constant follow-up with the banks for all the statements, all the bank statements, FDR statements. So what we tell the resolution professionals is that, sir, in case we don't get any confirmation or any bank statement or any confirmation on these margin monies, we will have to write that in absence of any information, any confirmation, any statement whatsoever, as on the CRP date with respect to these balances, we will have no other assumption but to take it as zero. And we will have to write this specific lack of information in the report And in case the COC sees this, or any person at a later date sees this opinion that the bank statement and the margin money statements were not available with the valuer or with the RP, it will be taken negatively by anyone. So then he is able to convince the COC members and get a statement. In many cases, we give the draft report and then these statements come to us after the RPC. This is something that will put him in trouble.
Yeah, absolutely right, Ankit. And that is the reason they have said that margin cannot be directly settled. And if you're not getting information, then you can write, okay, I don't get the information. But if it is getting information, they will definitely come back to you for sure.
But COC never sees the report because you don't share the report. The problem is there's only RP sees the report, and RP is very well aware what the comments are written. So because he is the one who has provided the information, he is the one who has responded to the emails. So this statement will never come to the light as long as RP is not privy to that information.
Nowadays RPs are very scared because in one of the recent judgment where RP was arm twisting the valuer to give a certain number, and valuer was denying to give that number. So RP said, I will not give you fees. This matter went into IBBA proceedings, and that is a reported case law. And the IBC took very strong stand. IBC says, if anybody pressurize values, we cannot tolerate, because he has to be independent. Because the moment you tolerate him, you would give him something different and he changes his value, our entire IBC structure will fall down. Because, and they also quoted, and the regulator also quoted the case of Videocon. They say if the liquidation value is quoted 2,940 crores and somebody is giving a quote of 2,960 crore to buy, someone has leaked. They say we cannot say who leaked it, whether it is a valuer office leaked it, whether it is a RP office leaked it, whether it is a company, somebody else office would have leaked it. Even despite signing NDA, somebody would have leaked it. They say we cannot tell now. We are working on to find out from where it got leaked, because the matter is pending under Supreme Court as of today also. So what they said is the reports are very confidential, but somebody leaks it, make it out, it is a huge challenge. And they are saying we nobody can pressurize valuers, and IBB is taking strong favor for valuers that whatever you need to report. So they have gone one step ahead. They said you, and this is a quoted recorded event of that 18th October. They say, if you have any other information which you want to highlight, put in the report also, which is beyond our scope. Okay, you observe something, you find something which they are trying to hide. They say, then we add a discussion with that chairman, that person that says, we cannot go and write something that I'm not an investigator. My job is only what assets you have given me, let me value. No, we also expect value to find something which is hidden also, which is definitely going beyond my scope, which I would not like to enter in that scope. But that's the regulator is expecting. So somewhere they are protecting values. They think you write what you want to write, and we'll be there to support.
But there's a counter argument to this, Sumit. The problem is, as an IP, I'll tell you what, IP is responsible for the valuation also is getting, because while if the I know two definitive cases where IPs are struggling because valuers, while we say two valuers are appointing for asset class, independent and all that, in practice, majority of us know both the values are in discussion and they come to a value which is closer to the numbers. Whether one is doing correctly, other is doing correctly, I'm not even getting in there. The challenge here is if the values they have arrived at are not justifiable, and since RP is the face, because at the end of the day, if you see IBC code, RP is the face. So RP, when he questions that this value is not justifiable, because he does get expressions, he does get idea of where the value is happening and all the stuff, he does share the information, and values, if they're not budging in, you cannot, and if both the values are giving almost near value, he has no choice, and the company ends up in liquidation because of the irrational value that the values are giving. And this has happened specifically in definitive cases. I know the cases.
Yeah,
not where I was
in. And in one of the cases, NCLT said, let the CD should also comment on the valuations, because the owner knows much better his valuation than
exactly. This is what has happened. Invariably what happens is the valuers, being a valuer also, I'm not undermining any valuer, but the valuers, when they are trying to put a broad level quick number without understanding, for example, there is a large land parcels of land are there and they're litigated completely. It's in high court and it has to come in. And valuer is saying, okay, because it is litigated, I'll give a 10% discount. It's irrational. It's a 0-1 game in a litigation case. Now, so either they have an extreme way of logic, and there is a previous term sheets which has quoted at a 30% of the value in writing that promoters have received. And the valuer is quoting 4 times more as a valuation. So when you are saying here that RPs should not interfere valuers' independent judgment, the challenge is if both the values are giving the same value, it becomes a Herculean task Because if valuer says I'm not agreeing and he has to go to the court, these valuers are stupid and he's taking on valuers. If he tries to tell valuers, boss, realistically look at it, then he's interfering in valuation. It's a big dilemma over there.
And I always say wearing an IP crown is full of thorns. It is not a bed of roses. It's full of thorns. Whatever you do, somebody will come and say, "Oh, you did not did right," and question against the IP, despite he is trying his best intentions. But in this particular case, actually, there was a malicious intention in this particular case. For some reasons, they need to put some value, lower down the value for some reasons. But generally, IP, you should not come under pressure. Generally, as a valuer, one should not be pressurizing valuer. So that's what the IBBA is saying, that nobody can question valuer what to do. In the sense, nobody can pressurize valuer to give certain numbers. It is his choice. If it is not agree, go to a third valuer or go to other points. And now they gave a difference of significant difference, 25%. That is also a huge caveat for appointing third valuer now. The common mistakes which are observed was people are writing in a report, I'm using one standard, but the definition they are putting of other standards. And this generally happens on copy paste. So if I take, let's say, Ankit report or anybody report and I use that report in copy pasting, so he would have done a validation based on his standards, and I'm saying, oh, I'm different RVO, just change the name of standards, but the definitions are also changed. So one need to be very careful what standards you are mentioning, the definition is actually from those standards. Scope of work is mandatory. I'll take those important points.
Sir, a small doubt again.
Please.
In a previous example, what the other gentleman is speaking, suppose the land is litigated or a leasehold right is cancelled, suppose those kind of things are there, then the value should be either 0 or 1, or you can make a proper discounting of 10, 20%, 30% and do something. What should be the approach of a valuer then?
So 10, 20, 30 is not debatable. So either I will give, say, this is a value, and then also I will write in bold and caveats, though this value holds good, but since the litigation is matter in the court, so the reader may view discretion accordingly. So suppose there is a land which has a value of 100 crore, but just by saying it is a court case, so it might be 90 crore, may not make sense. Either it is a 0, as you said, it's a binary event. Either the land is your ownership or not your ownership. If it is your ownership, it has to be 100 crore. If it is not your ownership, 0 crore. But suppose you want to be more conservative, you can say, okay, it may take time to realize this value. So I'm giving it 10, 20% haircut, that you need to justify discounting value of money, that it will take 3 years to settle the case. So my value will be diluted by 3 years time period. That kind of factors you can take in. So that assumption you need to work out that, okay, this is the reason I am reducing the value. I will not get 100 crore today because litigation. So it will take 2 years time, 3 years time, and do a present value discounting. Let's say assuming 3 years we won, and suppose that you have won at district court, high court. So probability is in your favor more if you have won all the lower courts. So that way you can take a judgment by diluting the some value.
Even the discounted rate may be either that figure, suppose 100, instead of 100, I can take a 70. So it can be 70 or 0.
Yeah.
So can I say this? I'm just sharing my experience. There was hardly 1.5 crores loans and one in IBC valuation, but they were all litigated stuff. It's a real estate stuff. So I actually asked for the legal petitions. I actually asked them to give the petition documents to me. And since I have understood, I have gone through it. And if you believe that you cannot do it on your own, you say that you will appoint an expert of some kind of a legal assistance to read the documents. So what happens is when you see the petitions, you know which stage, not that you're going to make you're not a judge eventually will take a call. But when you read the judgment, when you see the petition, whether they have actively participated in the counter judgment, based on that, you have a reason either to give a 0 or 1. That would help you because there are no distress fundings in these cases in India where you get a 30% I'll buy it and I'll take the risk and all this. So if the pleadings are such that there is so much of value, not the title issue, this is a value impact. Then what you can do is this is the total market value of the property. If the downside is there, this is the loss to this particular person. So net of this loss, this is the value. That's the downside. So such kind of a decisions you can take when you read the petition or when you read either yourself or by yourself or taking a legal assistance to take a call.
In fact, the IBBA official that day announced also, now we'll be writing making one change also in the regulations of IBC that the COC and the RP should share all past informations also to the valuer, which let's say you're taking a loan with a bank and bank had some issues, you have certain other reports related to that company. That data, if required by a valuer, it should be given. So you should know what is in that done in the past. So earlier this information was not given saying privy, but they say we will get all information available to valuers and putting pressure on COC also. Because most of the time COC or bankers, they had your other reports also. You need to mention mandatory why you have not considered other two approaches mandatory.
So in case in IBC valuation, can the valuer ask for the reports of the valuation reports of the banks done earlier during normal periods?
Yes, yes. That's what they have said. This time we have making this amendment this time. It was not there earlier.
No, I know that there is an amendment in IBC saying that RP can ask for the bank earlier reports, and banks are obliged to give it now.
And that will be now shared to valuers also. That's what was said on this last meeting, 3 days back meeting. That's what they mentioned. So that will give a perspective to the valuer what was there earlier.
Sir, I have a doubt on this final value. Now, do I have to give final one value, or can we give a range, sir, around 120 rupees?
Generally one value.
Sir, now my question is, assuming that when we are giving the valuation report from IBA ratio 6:1C, for the same value when you're issuing a shares at a premium, when a merchant banker issues a DCF report, then if there is any difference, then there is an income tax issue. How can we arrive the same number? Is it we can't give, no?
Tell the merchant banker to give a higher value.
Merchant banker to give.
Then it will not have income tax impact.
Okay, fine. So then if we can't issue the, now somebody has told that we can give the range between around 20-25 rupees.
In India, they don't permit range. Globally, range is accepted. In India, because in FEMA and other law, it's a certificate. So it has to be one particular value. You cannot give a range. That's why they prefer one. In giving an opinion, so if you're giving an opinion, then range is okay. So in many court cases, I've seen many court cases reports where values are given range. It may range between 100 crore to 120 crore, that is fine. But that's an opinion in a litigation matters. But when you're doing share issue and another thing, that has to be one particular number. That's my view. Anybody has a different view can.
Sir, I just would like to point that in the draft report which is published by ICI, in those draft reports, it is clearly it is mentioned that the equity share value ranges from this to this as on this date in the opinion
and the board
part.
can decide. Based on the board can decide what is the value they would like to adopt.
And even I have given such reports, and those were accepted in FEMA for RBI for filings also. Because what used to happen, if we give a fixed value, then there is a foreign exchange fluctuation in that. And if there's an increase in value, then again the our report won't survive, and then those adjustments used to be required to be made, and etc. used to happen. So to avoid this, we used to give the range, a significant like 5% plus minus range.
Many authorized dealers, I got a point. Many authorized dealers object on giving ranges. So it depends on if authorized dealer is accepting, then RBI will accept. Certain authorized dealers have a challenge. They say it's a certificate should have to be a fixed number. Opinion can be a range. Certificate has to be one number. So when we say it's a valuation certificate has to be particular number. Certificate cannot be opinion. That's what the authorized dealers view. Globally, range is acceptable globally, but in India it is not preferred. And in legal cases, it is always there. They give range. I've seen a few legal cases reports which are available in public domain. Also, the range have been given.
Giving a fixed value makes valuer a god. Highly not acceptable.
Which cannot. So the businessman knows much better value than the valuer always. He knows the real value. So range is, a law may not have that much inclination towards range. But if the AD accepts, then it is okay. We need to give definitions of fair value and liquidation value mandatory. These definitions need to be given in report if you're giving IVC reports. Past history, as you mentioned, need to have a past history background of the company. That needs to be there. If it is a wholly owned subsidiary, you need to give your ownership, who's the real beneficial owners. These cannot be ignored. These are mandatory. Then the second comment review happened, and they started getting various detailed, minute comments that you don't have proper work, you don't have errors in calculation, consistency was not there, assumptions were not mentioned, sources of ownership was not mentioned. So these are the specific points they questioned that it should be there. Conclusion need to be there, restrictions, these we just talked about. Then they had another meeting in 2021, and this time the number of errors were less. But again, they were coming same, that people are standardization disclosure was not there, history was not mentioned, They have not mentioned the details, whether you're doing valuation on going concern or not. Again, scope of work was not there. Authorities was not mentioned, who appointed what. Report stated that valuer takes no responsibility for data. They question on this kind of reports specifically that you cannot write, I will not take responsibility of data. You are supposed to take responsibility of data because you are presenting it. That's specifically when the caveat limitation disclaimer guidelines were issued by IBA. And then they question on, again, they question on this one, clause 8.3, that your report do not have structure of clause 8.3. Whatever the points mentioned in 8.3 should be there in your reports. Definition should be in your report, what you are defining. Limiting condition, these are general comments. I'll skip the important points. Now, few blunders which have happened, that if I'm doing valuation is on 15th February 2020, that is only 1.5 months left for the year 2020. I cannot do in my cash flow entire year cash flow discounting. So they've done discounting of entire cash flow by present value. That should not be done. The past cannot be discounted. Only the future can be discounted. So past discounting cannot be done. People just they made a mistake of putting a formula. You need to mention COP number. So many other RVOs have a concept of putting COP number. So this particular to one particular RVO. Ours, if we mention our IBBA number, that is more than sufficient. If further you want to mention your particular RVO number, that is more than sufficient. And it should be mentioned under defining you. When they say identify value, you can mention all your particular details there. So it not to be repeated again and again. Certain basic checks we need to mention, that if I'm valuing any instrument, I need to mention what is the face value of the instrument and what is the fair value. That's somewhere I need to mention, whether it be CCD, CCPS or equity, face value should be mentioned in the report. Anything executive summary, if you give it is fine, if you don't give it also it is fine, but they preferred, it is not mandatory to give executive summary, but they say it is preferred to have executive summary. Typo errors need to be mentioned. This again, disclaimer that whatever client has given is fine, should not be mentioned. You need to give reasons if you are rationalizing subsequently. Just cannot say given by management. Standard discount rate of 30%, 40% is not acceptable. You need to give some basis. Certain reports do not mention COVID crisis. So due to COVID, there has to be changes in projections, which you need to give impact either in discount rate or projection somewhere. It should see a light of the day. When you are having IT services, your intangibles valuation should be there. So all IT companies will have some intangibles, maybe in softwares or maybe in terms of certain customer contract, customer list, that should be captured when you are doing purchase price allocations or any other valuations.
Sir, normal business projections, intangibles, do you need to consider separately?
No, for when you're doing a specific, not for DCF, when you're doing specific deals of IT companies, when
Sure,
buying out or selling out, in that case, it has to be considered.
Okay.
Now, in the third inspection, which just happened in 21st April 22, recently, last 9 months, 6 months back, they questioned that we should not have the same reports.
Sir, there is
Yeah.
one question, sir.
Please.
So what if we have, we don't have any limitations or some critical assumptions to mention under the assumption tab? So where we are giving the assumptions or limitations during calculating the valuation. So at that time, if we don't have anything to be mentioned in the valuation report, can we leave it blank?
One should not leave it blank because there is a IBA has given one standard format. So take something from that format and paste it. That should help somewhere. So one could be, let's say, the projections is based on 5% growth rate of the industry, or the no technological changes in the industry. Let's say when pager would have come, then pager would have different assumption in growth rate. Or when the CDs compact disc was there, their growth rate would be different. But then the cloud-based technology comes, their entire growth rate goes down, and Moser we have gone into liquidation because nobody is buying CDs now. Everybody used to buy compact disc at one point of time. So your growth depends on no disruption happens in the industry, right? So somewhere some limitation you point out. Well, the reason I'm saying is, again, it sounds very rhetorical, but why we are putting this is the reviewer. See, I just miss your good name. You're Kusum, right, or Maithili? I'm not able to see the.
This is Sheetal here.
Okay, yeah, Sheetal Mandana. Okay, Sheetal, if you are an auditor and you go to audit someone, and regulator has asked you to audit, would you like to give a clean report, or you would like to pinpoint some point? What will you do?
No, there would be definitely some points. Yes.
And if you are giving a clean report, then even though there is the valuer has done perfect job, If you give a clean report, what will happen? Sheetal will not have done her job properly, even if you have done everything right, right? So that's why they put some point. At least this is a mild observation we found. So I don't want to give any reviewer some point that okay, it is not there. So try to put as much as possible given by caveats, because what does IBBA say? We had made disclosure for you and you're not even using that disclaimer. So they had made this document. So use some point, if even it's one line, that should be fine. That should be okay.
Okay. Got it. Thank you very much.
Thank you. Regarding the point we just talked about in the starting, that we should not use same report. They did not say we are unclear whether the report is done by CA or valuer, because multiple same lettered used and different references. So we should avoid. Legislation number, which section you are issuing report, they say it is preferred you re-verbatim put into the report. So if I'm using section 61C, paste that section in the report so that there should be no errors. Like here, the valuation for the infusion of funds, he did a valuation of section 230, which is not acceptable. Rest, okay. You are doing a book value approach, okay. You are impairing one client is saying, take out of 10 investment, 9 investment and book value. 10th investment, you discount it by 90%, whatever reason, impair it. Impairment is fine, but the question is, company has not done the impairment in audited financials, then how come valuer is doing in its valuation? Either you follow standard for all 10 assignment, 10 investment, same logic, or you cannot just say client has said to do impair, so I'm doing impairment. If it is need to be done, it has to be done by an audited also. So if auditor has not left it, there has to be some reason, and that is to be bought out. Specific cherry picking cannot be done. Past review should be there. Like in one of the model, they have put volatility at 0.001%. They say they have not explained why 0.001% volatility has been put there. And there's the reason why they would have put there is, anyone can think of why somebody would have put 0.001% volatility? This volatility, why
Six
somebody
Sigma. 99.999, they said everything is good.
No, they say if you put zero volatility, the model will not work. So I need to put some number in the get the model run. Otherwise, model will show infinity numbers. So that is the reason they put this number. But they need to somewhere mention. So this was showing improminent. Valuer was using other approach, but since it was copy pasting, so he's saying he was using DCF approach. But he's saying, hence we abide using cost approach for valuation of this company. So the valuer, they commented that the wrong selection of word. So when we not to copy paste, that's a challenge. One challenge they mentioned is that you are showing all going concern assumptions, but the 5 years it is losses. So like just somebody asked, if I can show somewhere that, okay, the holding company is giving a commitment that whatever loss happens, we will fund. So that need to be shown somewhere. If the forecast prediction is also showing negative results, you just cannot say everything would be fine. If you're using two approaches, cost approach and income approach, you cannot take different dates. So for cost approach, you have taken 9 June financials. For income approach, you are taking 1st April, because client will say, "Ab kaun banayega 9 June tak ka?" It will be challenged to make one separate financial for April to June. You assume you cannot take that. Either take same dates or have a give a caveat that this date is not available, because 2 months discounting you cannot do back. Past cannot be discounted. So consistency has to be there in the reports. Then the peer review give a suggestion, peer review committee, that lot many people are saying that client is not giving projection, saying it is a price sensitive information. So that's why we are not using income approach. So which the regulator says it may not be a right approach, because otherwise everybody will start making this assumption that it is sensitive, so I will not give you data. Even the listed company gives all data to the analyst and all, so it should be there. And when you're signing NDA, there has to be some rationale why we are not using this data. Specifically for big companies, they say, I cannot give you predictions, is a questionable. Discount rate should be mentioned. What standard you're saying should be mentioned. Identity of value should be mentioned. This is because 2 reports came to NCLT where valuer has given somebody else number, which either typo or intentional, we cannot comment, but the detail should be there. Again, they have mentioned that you should reproduce the section. This is a good practice to reproduce the sections in the report so that you will ensure that mistakes has not occurred. Now, a common point which was noted by, when you are using NAV method, net assets method, what lot many people does is they just paste put total assets less total liabilities without giving details. So they say when you're using NAV, you need to comment on broad heads. that, okay, tangible assets contain this assets taken at book value or fair value by management or valuer. Current assets include DTA, DTL, whatever it is. So somewhere comment should be there on that. Just putting one number and try to give less information is not preferred. They say otherwise, how do I know what is the nature of asset or liability? Now the reviewer also commented one point, which is the last point in the report, that please allow some fee structure for the reviewers also, because as of today, none of the reviewers are given any honorarium. This is a pro bono service they do for the profession. So they say we spend so much hours and time to review so many other reports and give some value. So there has to be certain consideration for the time we spent. So this is a demand from all RVs and all values who are doing that. But as of now, no decision has been come on that. Now I'll skip and take last point. See, there are so many valuation issues. We understand biases is there, uncertainty, black box, information overload, skepticism, insufficient documentation. Everything is debatable, arguable. Last point can never be debatable and arguable from any side, whether I did it or whether you did it, this kind of errors. So if there is a human error in punching data, you cannot blame system responsible. And this is a valuation report by one of the big firms in India, and it was caught by department. And what was the issue? The enterprise value is coming this, cash is coming this, debt is coming this. The system will follow the only command you given. And he would have given a command here, this plus this minus this, and minus minus become plus. So instead of reducing 21 crore rupees debt, it added. So instead of getting value by 638 crores, it became 680. So double impact has happened. And it became a huge issue. This kind of errors, one need to be very careful. You cannot simply rely on your articles, all juniors. One need to be very careful on systems approaches, whether client, do you think client will actually look at numbers? Client is least bothered what you're giving. Client is only considered on these kind of numbers. But as a valuer, you need to see this process should be, when the regulator caught it, a very heavy penalty need to be paid to the company. Valuer was given scot-free, but this kind of errors are not arguable or not dependable. With this, I thank you all for your patient hearing, and I open to any questions or suggestions which we can take and have any points particular to discuss.
What kind of reason one gives for valuation of receivables in IBC?
So in valuation of receivables, just give me a minute if I can show something. See, I need to show in valuation of receivables what data I have got. So if the client has given me, let's say if my RP has shared me some data of what are the confirmations he received, then that becomes a strong point. But if RP is not able to give any confirmation, then I need to do my background homework check. So just let me see if I can show you. I'm looking for that one number. Yeah, just give me that. So
and in that case, what will you write? IBS, basis of premise, basis, all that stuff. What do you write for? Yeah, please. I'm waiting. Yeah.
So what I generally do is, let's say, for example, we did a valuation where these are certain customers. Okay, these are private limited companies or public limited companies. Now, if I'm doing valuation as of today, so we did a valuation in 2021, this company. These customers are all, if it's a listed or private limited or limited, the data should be on MCA. So in 2021, if I'm doing valuation and I could not find the company financials, or this Radhika Silk data has been deleted, company is defunct, so then there can be no value I can assign. Because there is no data available on MCA, if it is a private limited and 5 years it is not filing a data, 2016 onwards no data has been filed, then what value should I give? Then I need to give a haircut. And we write that, like, here, if you see the last, let me see if I can show annotation. So we write here that, our IRP sent the recovery letters. He has given a copy that all recovery letters sent, and all got bounced back. And they got bounced back with the record that no such address available, no address he found, refused. So when I've got all the data, I'm saying, they say, I'm not going to give you any penny, or data are not available. Then in that case, I need to go to do my background check. So IRP has confirmed that I'll not be getting any value from these companies because they have not responded. So I also try to do my homework by saying, looking into the MCA data, whether it is actually company available or not. So that gives a strong ground. Now you can imagine, see that data of, let's say, almost 9 crore value, we are giving 1 crore value. So the bankers questioned us a lot that how can you give 9 crore value 1 crore? And when they looked into the reasons and justifications, when they checked the data, they accepted that. That okay, fine, the company is not available, then what can I do? So that is the way we can take some way to argue that how I get a value, because I do not have a right to contact the data. At times when RP says you go and contact data, which I would not like to go and contact that data. That is not my scope or not my area which I work.
Sumit, see, even you have given 1 crore value. On what basis you have given that 1 crore? Because you have taken some 50%.
We have looked into the financials. We have looked into the financials and we have looked into the past data that where how the company was providing. So it is not an old outstanding debt. It is a regular debt. Knowing that the company has, knowing that the company has gone into IBC, so the debtor may try to not give. So then the legal litigation process would have started. And then we discussed if the because the company was paying regularly in the past year, so that was not a challenge. Even if the company don't want to pay for any reason and the litigation goes and the bills are genuine and accepted. So we have seen the invoices and the client has accepted the invoices. And then we have taken a base that, okay, if we go in liquidation, it will take 3-4 years time, how much discount we can take it. And then we taken that numbers. And then that happened after the COC, because earlier we had taken a higher number. Our number was higher. But then the COC argued, COC says that, it will take 3-4 years in litigation, so it has to be reduced down. So then it has curtailed down to 50%.
What do you call the approaches for this? Receivables, valuation of receivables, which approach you are referring to here?
This is replacement today. So we'll take cost approach today under cost method. Today, what I'll be able to get this number. So when I did the valuation, when I did the assignment, when we did the transaction, the value would be 1 crore, maybe. But today, the person who is able to give money, what is his worth? If his worth is only 10 lakh, then your value is 10 lakh only, the debtors. The goods you have given 1 crore. But the guy has already siphoned the money. He has not done any filing of ROC return for 5 years. So that is not any value. You cannot reproduce, replace. That's the best number you will take it.
So the best method is we can take balance confirmation. If you don't receive the balance confirmation, we cannot receive the money. Because unless
that's the best way.
Yeah, because if we are not able to get one mail from the debtor, do you think that we will get amount from him? Crores of no.
But it doesn't come under the definition of cost approach, sir. The replacement approach definition is something else.
Sir, for in the case of IBC valuation, it is a realizability we have to see. As per IBC regulations, realizable value on the date of CRP commencement date, not approach. Realizability is 0 because there is no balance confirmation. Because as a IP, we are saying that for trade receivables, crores of rupees, single paise will not come. In past experience, we can see that.
No, and that is the reason. That is the reason IBC has given a draft. IBC is working on a draft report of valuations of IBC. What should done? They say we have seen crore of rupees going 0. They say which may not be the right approach, so we need to look into it. And there is no approach which directly fits this method. So that's the reason they put cost approach. Because somewhere I need to write standards, and no other standard put this kind of assumptions approaches. There is no such report which we can put in. That is the reason IBC reports you will see always using this cost approach only.
So they call this as cost approach.
Yes.
Okay.
Sumit sir? I finished at 9:30 sharp.
Yeah, basically, if any other participant would like to raise, we can take one more question last. Mr. Prakash has raised.
Sumit sir, going back to the receivables valuation and between fair value and liquidation value, what was the logic? If you can please repeat that.
See, if I need to see what is my outstanding. If somebody is outstanding from last 3 years, okay, for sure, then it has no value. Because if some debtor is not giving me last 3 years and I have no surety, no collateral against that debtors, so just last 3 years when before going IBC has not paid me, then after going into IBC will never pay me. But if somebody is a regular debtor, even in CRP period, he is doing transaction with me, then there is a good probability that he will pay me because we are working regularly with him. Now, if I like to go to litigation, what is the best probability time period I can get? So 3 years, 5 years. So based on that present value discounting, we can work on if there is a genuine amount due and the bills are accepted. In many places, bills are overly inflated, and some places the the debtor is given a confirmation that I have given cash to the party or I have given payment to the client in some other company, because where there are normally group companies, the CD will say, okay, instead of paying me company X, you pay me company Y, and we'll pass a journal entry. That kind of adjustments at many places happen, or cash transaction happens where there are GST issues and all. So I need to look into what data I have. If RP can give a data that, okay, we have sent a confirmation and it's all returned, nobody is giving, then fair value would be 0. If the debtor is saying I'm not giving you, because as if you do a undervaluation, it is a crossing the deal. If you do a overvaluation, you are killing the deal. Because if the debtor is not supposed to pay, you are not going to pay. So we have seen one report, 700 crore debtors given 70 lakh value only, because all the debtors were in Delhi in Loha Mandi, and in Loha Mandi the address were X Loha Mandi, Y Loha Mandi, Z Loha Mandi. That's the addresses available with the company. And when the letter was sent, they say no such company ever existed. These are all book entries company, dummy companies. So there, then you need to give a fair value 0. The bankers did not like 700 crore debtors giving 0 value, or 70 lakh value. But then they actually looked into the data, they accepted the values fake, because people have routed the bills, dummy bills, and make fake entries to take higher bank loans. That's what they did.
Okay, so sir, this logic for fair value is clear, but from fair value to liquidation value, that is what I was trying to understand.
Then it's the assumption we take. Then it's the assumption we make.
And sir, what would be the basis of the assumption? Will it be a percentage? If that percentage, what basis of that percentage?
Percentage generally 20 to 30%. That's a generally percentage. But again, also depends on what is the entity is. If it's a list, if it's a company, I will give a less discount. If it's a company, where it is an individual or partnership firm, we will give a higher discount, because the company generally is a regulated entity, can have more probability of recovering money faster rather than individual. Because the company works in the different regulations.
Okay. Thank you so much, sir. Thank you so much.
Yes, friends, let's call it a day. I'm very, happy to hear to Mr. Sumit today, because I understood, a couple of things, maybe I will have to relook into, my sincere request is to Mr. Sumit is please share your PPT with us, so that, all of us could relook, yes, we have listened to you, but then we want to relook our reports, try to match whether a particular statement, mentioned in your PPT, am I covering, not covering, just one, cross check. So that is my takeaway for today. And one more takeaway I had is whether IBC valuations being extra conservative is right or not. Every valuer has to revisit. Whereas in startup valuations, many a time we sometimes take conservative or sometimes we take aggressive. But then IBC valuation, it has an impact. We could be questioned by the reviewer. So we have to have a real kind of valuation with all the justification, with all the points. Okay, so that's my takeaway. And I request Kusum to give a formal vote of thanks on behalf of our association to Mr. Sumit.
One request to BVM. Can you please share the recording also? Because
in fact, I myself had that desire internally. I'll just have a word within the committee, and then
the program is very useful, and we can avoid so many mistakes.
Yeah, because this is a special session wherein you have to visit and see, whether you're actually doing it, or in what cases you might have erred, in this particular thing. That revisiting is required. So I will just have a word with the committee, and then try to share. But maybe I'll be sharing only to the actual participants, not to everyone. Let me see. Let me have a word with the committee, and then I'll get back.
Leonard Sumiji has got a lot of knowledge, and his presentation skills are so great.
Thank you, sir. It is all we learn from peers only. And I'll be sharing presentation immediately to Shilpaji, but only one condition. None of you would use this PPT against me when you come to review my reports. So don't use that as a weapon against me. Okay.
That is assured from my side, and probably on behalf of everyone.
Thank you, sir.
Actually, one concern what I had is he has already taken this session in other RVOs. Okay, that was one concern. It is actually a repetition for him. So I was actually wondering whether to repeat not. But then considering the gravity of this topic, that no one member can be left without knowing about this. So I thought even at the cost of repetition with other RVOs, let us go for it, because this is a real value addition for our reports from the reviewer's lens. Okay.
One last recommendation.
Yeah, please, continue.
One last recommendation here. All of us as a valuers, we should do the reverse battle that IBC has become a compliance law than a business law. Now they are enough ready to screw up the valuation exercise also. So we all have to fight back to ensure that this doesn't become more a bookkeeping exercise than actually to exercise. All of us have to go back now and fight this out.
And as just to give my last views on that, so me, Ankit, and Munish, 3 members of BVA were there, which I know that they are members of BVA. We 3 were there in that meeting, and the regulator said upfront, if the limits are crossed to a significant level, the regulator have to come in. Though we know we don't have a power to put monetary sanction on you, that does not mean you can go blindly कि चलो कुछ नहीं कर सकता regulator तो तेज speed पे गाड़ी चलाएंगे. Then they will put a strong sanctions and penalties on you. So they say we know you are doing your job and it's growing. We are also trying to build the capabilities how the best things can happen. That's why IBC has just come up with a draft guidelines on IBC. So we should not miss on that. And those who take IBC evaluations should ensure that at least go through that draft guidelines which IBC has just worked out with ICRU recently. Last 3 days back, I think they got it. And I
suggest that IBA should come out with a booklet as on what do's and don'ts. And
IBC has come up with that. IBC has come up on IBC evaluations. IBB has issued that booklet very recently. It's a draft booklet.
Okay.
Thank you, Shilpa ji.
This draft booklet is available now?
It's available. It is available. I'll share you that.
Yeah, please.
I'll share that email also.
Yeah, for betterment of all the members, if you share, it will be better.
Shilpa, I think as ICAI guidelines, I think I put in a group 1 week back somewhere.
Yeah, that is what IBC has worked on that only. IBC has taken that as a base only.
I already kept a group with 1 week 10 days back.
Yeah, sir, we are going to discuss in the next session, sir, that one, that ICAI report.
SEBI guidelines on IBC valuations. Actually, that is in fact our next session. That is also being planned so that, regulator is closely looking at it. We all have to understand the guidelines. Yeah. Over to you, Kusum.
Thank you very much. I hope I'm audible, Shilpa. Yes, good morning, everyone. I'm very honored this morning to present the vote of thanks. On behalf of the participants, I thank the speaker, Mr. Sumit Dhadda, and BVA for deliberating on a very, very important aspect in current times, which is peer review. So peer review is an important aspect of evidence-based practice. It is priceless to receive constructive feedback from our own colleagues. It will help us open our eyes on areas which we did not pay attention to. It is important that our own peers who are experts and who were not involved in the particular valuation assignment critically appraise the valuation report and the relevant workings to ensure that it meets the standards of ethical conduct, quality, and rigor. So we thank the speaker, Mr. Sumit Dhadda, who is a peer reviewer himself and who has extensively reviewed valuation reports over months and years and has brought to this forum's attention the common mistakes, oversights that professionals inadvertently adopt while issuing the report. He has brought out the fact that more fiction is written in Microsoft Excel than in Microsoft Word, and he has also communicated that all valuers should follow the golden rule that write what you do and do what you write. Well, simple as it may sound, it is complex since the valuer has to be aware of all the regulations and at all times have to be alert enough to follow the set of protocols. It is a humble request from my side as a valuer and as professionals that we all should go through this peer review committee report and the presentation which Mr. Sumit Dhadda will share, and we follow it. By and large, we have to follow it to make sure our reports are carry that kind of quality. Sumit also brought out the fact that there are two things that come to my notice. The worst problem of peer review is that it is time consuming. I'm very sure Sumit will agree on that, and the fact that unfortunately they are not compensated for their time and efforts. But yeah, and coming to time, Sumit 30. So, thank you, everybody. Thank you, all the participants. And we request you to kind of make use of this very, very valuable session. And thank you, BVA, for coming up with, a very important and relevant topics. Thank you and have a wonderful weekend.
Sumit, last one query which I forgot to ask you.
It can be. It can be.
It can be.
It can be.
It can't be.
It can be. Why it can be? Why it can be? Because if there is a deficiency in your report, if a deficiency in your report which you have blundered, so that's why it's what saying they will not comment on the conclusion of value, but if your process is flawed, your entire process is flawed, then they can go against you. If your process is flawed,
the peer review report will be evidence.
it can be evidence if your process is flawed, because they will take certain bases. So your process cannot be flawed. The numbers can go haywire, but process has to be right. If the process is right and the number come absurd, IB will not question. But your process is flawed, you have not taken data or you have not worked on the data, and then something goes wrong, then they say somebody has already informed you, updated you. But RVOs do not share the report to the regulators. RVOs always mask and say we reviewed the report. They never even tell the name of the RV. That has not been told. They just say one valuer noted, this is the report LNB, this is a deficiency noted. Then IBBA says, okay, you instruct all members of your RVO not to repeat those mistakes. So the repetition does not happen. That's a process it follows. But IBBA does not come to know that who did what mistake. As of today, they are not aware and they should not be aware. But if they instruct, they tell us you did a blunder, then they can. Like, for example, in one case, IP appointed relative as a valuer. Then that's a serious case. That should not be done. So that need to be taken care of. So with this, I wish you all happy Dhanteras and good wishes, and thank you me for inviting, and thank you Kusum for the warm summary you did for all points, and thank you Shilpa and BPA members and all present here for attending. And the report I'm just sharing in the next 5 minutes, and see you all. Have a good day. Thank you.
And happy Deepavali to everyone here.
Thanks all for participating.
Thank you.
Thank you.